To order. Without objection, the chair is authorized to declare a recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is entitled Monetary Policy versus Fiscal Policy, Risks to Price Stability and the Economy. I now recognize myself for 3 minutes to give an opening statement. Today is not the first time we have seen a breaching of the line between monetary and fiscal policy. Unfortunately, Congress has a long history of forcing the hand of the Federal Reserve to accommodate its profligate spending. However, following the 2008 financial crisis, the Federal Reserve needed no prompting by Congress to pursue policies that are accommodating Washington's unsustainable fiscal policies and distorting the allocation of credit in our economy. As Renee Haltom and Robert Sharp explain, prior to 1951, the Fed's monetary policy was effectively determined by fiscal policy. That is, the Fed formally agreed to hold interest rates down to facilitate the Treasury's financing needs during World War II. This policy ended with the Fed Treasury Accord of 1951, enabling the Fed to focus solely on monetary policy objectives. Next came the Interest Adjustment Act of 1966, which required the Fed to reduce interest rates through various channels. But to the dismay of many in Congress, the Fed delayed action on this authority, knowing that such actions threatened monetary policy independence. With more arm twisting by Congress, the Fed would go on to purchase agency debt in the 1970s, mainly through Fannie Mae, the Export-Import Bank, and even a $117 million loan to the WMATA to build the Metro in Washington, D.C. In those days, the Fed was more resistant to political attempts to force it to interfere with fiscal policy. It recognized the limits of monetary policy and the economic damage that follows from using the Fed as a slush fund for individual interests. Today's Fed has done a 180, initiating on its own several rounds of quantitative easing that dramatically increased the balance sheet's size, in considerable part by paying excessive interest on reserves to fund massive purchases of mortgage-backed securities. Why does this matter? On the one hand, our unsustainable fiscal policies threaten price stability. When governments cannot pay their bills, they are prone to leaning on their monetary authorities for accommodation. On the other, the Fed's foray into credit accommodation, masquerading as monetary policy, only deepens Americans' distrust in their government. Under our Constitution, a Congress that is accountable to voters decides how much and where to spend. A Federal Reserve that has taken on that authority by itself weakens the independence of monetary policy, accommodates our unsustainable fiscal policies, and distorts markets. A full 8 years out of recession, and America's typically resilient economy has yet to fully rebound. A more accountable and disciplined monetary policy would go far to get us back on track. The chair now recognizes the ranking member of the subcommittee, the gentlelady from Wisconsin, Gwen Moore, for 5 minutes for an opening statement.
Good morning, colleagues, and good morning to our esteemed panel. I just can't wait to delve into this conversation. Although the committee has had several hearings on Fed Reserve policy during and post-crisis, my thoughts of this are on the record. I have just listened to our distinguished chair talk about the Fed kind of dipping into our policies here, and yet we've complained continuously about economic growth, and basically saying the Fed should have stayed out of the business of trying to right our economy, and they've supported contractionary fiscal policy here in Congress, and then complaining about the Fed's policy to try to help stimulate the growth. I'm sorry, I just don't get it. How can you have any credibility about being pro-growth in our economy and then saying the Fed should stay out of it when what we're doing on this side of the Capitol is calling for government shutdowns, defaulting on the debt, cutting food stamps during a recession, cutting Pell Grants so our kids can have an education, cutting cutting unemployment benefits and other counter-cyclical safety net programs, slashing budgets, cutting things like Medicaid, causing 32 million people to be uninsured. I mean, it's just curious, people, that for some reason, this Congress is talking up the economy despite the job creation numbers that are the same to slightly down from President Obama. Also, I've asked previous witnesses, want to see what you guys are going to say, if any of them thought raising rates during the recession would have been a good policy. They didn't. Wonder what you're going to say. You want to see where Republicans want to take the country? Look at Kansas. The state was right-wing Koch brother economic utopia, and it's a mess because of it. Stunted economic growth and credit rating downgrades. I'm hoping to flesh out some of this stuff with you guys here today. Thank you, and I yield back.
The gentlelady yields back. The chair now The gentlelady yields back.
I was just wondering.
The gentlelady yields back. The chair now recognizes the gentleman from Ohio, Warren Davidson, for 2 minutes for an opening statement.
Thank you, Mr. Chairman. Thanks for holding this important hearing. Before serving in Congress, I owned, operated, and expanded manufacturing companies in Ohio. As a businessman, I knew firsthand and the uncertainty in fiscal and monetary policy have substantial consequences for small businesses on Main Street. Companies are reluctant to trust the Federal Reserve or Congress to steer our country in the right direction. During the Great Recession, the Federal Reserve took bold steps to manage the crisis. They moved on with multiple rounds of quantitative easing and unconventional asset purchases. By purchasing trillions of dollars of Treasury bonds and mortgage-backed securities, they have kept long-term borrowing costs low and enabled the U.S. to finance massive debt while distorting asset prices, pension funds, and created even more weakness in our banking system. As Chair Yellen has indicated in her testimony, the Fed will move forward with normalization of its balance sheet. But in many ways, the Fed's monetary policy has accommodated irresponsible fiscal policy by Congress. We are on a collision course with a fiscal crisis. As economist Herb Stein said, if something can't continue, it will eventually stop. The fiscal challenge before us is to grow our way out of this debt crisis. Deficits do matter. While our national debt is not the sole responsibility for slow economic growth, we will highlight in this hearing, it is certainly a factor. To bring true long-term growth, Washington must move regulatory, fiscal, and monetary policy in the right direction. The Federal Reserve needs to unwind its large and unconventional balance sheet and return to normal monetary policy. Congress must act swiftly with sound fiscal policy that promotes growth and does not bankrupt America. I look forward to hearing from our witnesses, and I yield back.
The gentleman yields back. Today we welcome the testimony of Dr. Mickey Levy. He is the Chief Economist for Americas and Asia at Berenberg Capital Markets, LLC. Previously, he served as the Chief Economist for the Bank of America and Blenheim Capital Management. In addition to various corporate roles, Levy advises several U.S. Federal Reserve banks. Currently, his research focuses on U.S. and global macroeconomic topics. Dr. Eric Leeper is a Rudy Professor of Economics at Indiana University at Bloomington. His research has focused on fiscal and monetary policy analysis and the theoretical and empirical study of their interaction. Before becoming a professor of economics at Indiana University, he worked for 8 years at the Federal Reserve in Atlanta and Washington, D.C., and currently is a research associate with the National Bureau of Economic Research. Dr. Leeper earned his doctorate in economics from the University of Minnesota. Dr. Jared Bernstein is a senior fellow for the Center on Budget and Policy Priorities. He served as the chief economist and economic advisor to former Vice President Joe Biden. He also was the executive director of the White House Task Force on the Middle Class and was a member of President Obama's economic team. He has worked for the Economic Institute and the U.S. Department of Labor. Mr. Bernstein's research focuses on many subjects, including federal and state economic and fiscal policies, income inequality, financial and housing markets. Mr. Bernstein earned a PhD in social welfare from Columbia University. Dr. George Selgin is currently a senior fellow and the director of the Center for Monetary and Financial Alternatives at the Cato Institute. He also is a professor emeritus of economics at the University of Georgia. He specializes in monetary history, macroeconomic theory, and the history of monetary thought. He earned his BA in economics at Drew University and his PhD in economics from New York University. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Dr. Levy, you are now recognized.
I'll start over. Chairman Barr, Ranking Member Moore, and members of the committee, I appreciate this opportunity to provide my views on monetary and fiscal policies. Both monetary and fiscal policies have gone off course and need to be reset. Sustained, unprecedented monetary ease has failed to stimulate the economy. Aggregate demand has actually decelerated since nominal GDP has decelerated since the Fed instituted QE3. Fiscal policies have resulted in dramatic increases in debt, but they really haven't addressed some of the key structural factors that are undercutting economic performance. So both monetary and fiscal policies need to be reset, and they both involve significant risks, their paths right now. While alarming government debt projections, say by the CBO, focus attention on the future, future concerns are becoming today's realities. The allocative effects of the government's current spending programs and our inefficient tax system are harming current economic conditions. I fully understand the frustrations about the economy, the sizable pockets of persistently high unemployment, the low wages, the weak trends in productivity that have all contributed to lower potential growth. We all want better performance. But the issue is how to achieve it. As a wealthy nation, we are misdirecting resources through fiscal policy and relying on monetary policy for the wrong objectives. The reality is, monetary policy cannot create permanent jobs. It cannot improve educational skills. Monetary policy cannot permanently reduce the unemployment of the semi-skilled or raise productivity or boost real wages. Yet all too frequently, observers urge the Fed to ease monetary policy, or more recently, to delay taking away the excessive ease that has stimulated financial markets but hasn't stimulated economic growth. The Fed's $4.5 trillion portfolio and low interest rates reduce budget deficits, but this is temporary. Look at the CBO's forecast. And that temporary reduction in deficits encourages undesirable fiscal maneuvers and contributes to the Congress's delays in addressing fiscal challenges. It involves very high risks, and it really does jeopardize the Fed's independence and its credibility. The Fed must continue to normalize monetary policy by increasing rates judiciously. Note that the recent rise in rates since December 2015 has had no negative impact on the economy. And it must proceed with its plan to begin unwinding its massive portfolio, although I think the Fed should move more aggressively than their strategy suggests. The Fed must step back from its policy overreach, including the Fed needs to fully unwind its mortgage-backed securities holdings, $1.7 trillion, the largest holder in the world of mortgages. It serves no economic purpose. Just think about it. The mortgage market is functioning just fine. Housing prices are booming. Housing is going up. Why is the Fed in this strategy of allocating credit? Having said that, the need for fiscal policy, and I know this is a money and banking committee, but the need for fiscal reform is much, much more pressing. The entitlement programs, Social Security, Medicare, Medicaid, they're well-intended and they're important programs for the government and for American citizens, but their persistent spending increases stemming from their flawed structures have clearly impinged on spending for other programs, including infrastructure, job retraining, education, and research and development. This, in and of itself, the misallocation of resources, adversely affects current economic performance. It hurts productivity, it constrains wages, it reduces job opportunities for many working-age people, and it lowers potential growth. And I might note these entitlements are the primary source of rising debt projections. So I know my time's running out. Congress faces two paths. It can take one of two. It could avoid reforms, which would mean reinforcing continued disappointing economic growth, allow large pockets of underperformance in labor markets and slow wages to persist. This would generate mounting reliance on income support programs and place more strains on the government.
The gentleman's time has expired, but just finish the thought real quick.
Okay, my thought, alternatively, the only other focus is the Fed may pursue meaningful and fair fiscal reforms. And by fair, improve the structures of these programs while maintaining their intent. That would allow more allocation of resources toward government programs that would really enhance productive capacity. Now's the time to act.
Thank you, Dr. Levy, and we'll get more testimony from you in the questions and answers. Dr. Leeper, you are now recognized for 5 minutes.
Chairman Barr, Ranking Member Moore, committee members, thank you for inviting me to talk with you. The title of this hearing, Monetary versus Fiscal Policy, frames the issue in an unfortunate way. The title harks back to the unproductive Keynesian monetarist debates of the 60s and 70s. As I hope my comments make clear, a more constructive way to think about this is as monetary and fiscal policy. This is not merely a semantic point, it's fundamental economics. Basic economic reasoning tells us that monetary policy actions always have fiscal consequences. Let's start with something routine. The Federal Reserve raises the federal funds rate in order to reduce inflation. But this isn't the end of the story. A higher funds rate tends to raise all interest rates, including those on government debt. So interest payments on outstanding debt rise. Now fiscal policy comes into play. Those higher interest payments require higher taxes or lower expenditures in the future to service the debt. The message is, to successfully reduce inflation, tighter monetary policy necessarily requires tighter fiscal policy at some point. That fiscal response is essential for the Fed to be able to control inflation. But what happens if the fiscal response is not forthcoming because the fiscal authority never adjusts taxes or spending? Well, bondholders will see their interest receipts rise, but don't anticipate higher offsetting taxes. They feel wealthier and demand more goods and services. Higher demand raises prices, counteracting the Fed's original intention to lower inflation. Appropriate fiscal backing for monetary policy is critical for the Fed to achieve price stability. What I've described arises naturally from a fiscal policy that aims to stabilize the government debt-GDP ratio. What's important is that the private sector understands and believes that the fiscal response will eventually take place. Of course, when debt levels are low, the changes in debt service and therefore taxes are modest. Debt service has also been modest during the past decade because interest rates have been extraordinarily low. The fortuitous fiscal effects of low interest rates, however, may be coming to an end. This committee has heard previous testimony about the process of monetary policy normalization, but there's an important fiscal component to normalization that I want to highlight. Here's a little accounting exercise. The market value of gross federal debt is now a bit higher than nominal GDP. If interest rates on government bonds rise from current levels to 6%, roughly the average in the post-World War II period, Interest payments will rise over time by 5% of GDP. That's nearly $1 trillion. Debt service now consumes about 10% of federal expenditures. In the late 80s and early 90s, at its post-war peak, debt service was 20% of expenditures, but then the debt-GDP ratio was below 60%. Evidently, interest rate normalization carries substantial fiscal implications. I end by pointing to recent data that underscore the need to look at monetary and fiscal policy together. Short-term interest rates have been below 1% for a decade. Over that period, bank reserves increased by a factor of 52. Yet inflation by any measure has averaged less than 2% since 2008. Meanwhile, long-term Treasury yields have been trending down, suggesting that markets don't expect inflation is going to pick up. How can this happen? Well, massive growth in bank reserves hasn't created inflation because banks happily hold idle and safe reserves whose yield exceeds those in the federal funds in the short-term Treasury markets. But here's another fact with which you might be familiar. Gross federal debt has doubled since 2008. Why hasn't this been inflationary? In a phrase, bond market pessimism. During the financial crisis, there was a worldwide flight to safety. Investors had an insatiable appetite for treasuries. That appetite continues today, ensuring demand absorbs the expanding supply of bonds. The question for monetary policy is, what happens to inflation and the Fed's ability to control it when the thirst for safety is quenched? The answer hinges on the fiscal response. Thank you.
Thank you. Dr. Bernstein, you are now recognized for 5 minutes.
Chairman Barr, Ranking Member Moore, thanks for the opportunity to testify today. My testimony stresses the following points on monetary and fiscal policy, including important interactions between the two. First, to most effectively pursue monetary policy in the interest of American families and businesses, our central bank must maintain independence from the political system. While Congress should monitor the Fed's pursuit of its dual mandate, full employment at stable prices, it must scrupulously avoid any micromanaging of the Fed's work in meeting its mandate. In this regard, the Choice Act associated with this committee creates serious economic risks. By aggressively rolling back necessary financial oversight, the Act raises the likelihood of a return to underpriced risk, bubbles, bailouts, and recession. Title 10 of the Act, which establishes procedures by which Congress would micromanage the interest rate setting policy of the Federal Reserve, threatens to reduce the central bank's essential independence and hamstring its ability to respond to economic downturns and financial market excesses. This is the strongest caution I can offer you today. To pursue Title 10 would ultimately politicize the Federal Reserve in ways that would deeply undermine its effectiveness. A remarkable aspect of the title, especially from a Congress that claims it wants to reduce unnecessary regulation and red tape, is that it demands strict adherence to a policy rule, spelling out in detailed language a specific formula that the Fed's interest rate setting committee must follow or face burdensome regulatory scrutiny. This requirement is unworkable. If the FOMC strays from the, quote, reference formula in the Act, their rule change would be subject to 9 separate burdensome requirements, many of which are onerous enough to make deviation from the rule impractical. For example, within 48 hours of a policy meeting, the Fed chair must, quote, include a function that comprehensively models the interactive relationship between the intermediate policy inputs. She must, quote, include the coefficients of the directive policy rule that generate the current policy instrument target and a range of predicted policy future values for the instrument target if changes occur in any, and so on. And these are just 2 of the 9 requirements. I've been studying monetary policy for decades, and I'm not sure I know what some of these requirements mean. Again, this is an astounding read from a Congress that claims to be invested in reducing red tape and complex regulation. My testimony also explains why a rule-based policy must be, contrary to Title 10, applied with discretion. There are many variations to Taylor-type rules, all of which differ from the reference formula in the bill. There are 2 unobserved variables in the rule, the equilibrium real rate of interest and the output gap, and I assure you, economists are far from agreement on the optimal values to use in rule-based monetary policymaking. Figure 2 from my testimony shows what I mean. Using real-time data, The Title X rule hits its low point in the fourth quarter of 2009 when it recommended a federal funds rate that was negative 1.8%. Plugging in variance that mainstream economists endorse, however, generates a range of results from about -1 to about -7%. Turning to fiscal policy, the other subject of today's hearing, in 2013, Fed Chair Ben Bernanke made the following statement to this committee, quote, "Although monetary policy is working to promote a more robust recovery, it cannot carry the entire burden of ensuring a speedier return to economic health. The economy's performance, both over the near term and the longer run, will depend importantly on the course of fiscal policy." There are at least 3 reasons why Bernanke was right about this. First, once the federal funds rate hits 0, the Fed's firepower is constrained. Second, monetary and fiscal stimulus attack different parts of the problem in weak, demand-constrained economies. Monetary stimulus works largely through lowering the cost of borrowing, but people hurt by high unemployment may have too little income to take advantage of low interest rates. To the extent that fiscal stimulus puts money in people's pockets, say through infrastructure programs, direct job creation, temporary tax cuts, increased safety net benefits like ramped up unemployment insurance, people are more likely to take advantage of low borrowing costs and to signal to investors through increased consumer demand that they too should take advantage of low rates. Third, monetary and fiscal policies interact in recessions to boost fiscal multipliers. My testimony shows that before Congress prematurely pivoted to fiscal austerity, the 1-2 punch of fiscal and monetary policy was effectively pushing back on the Great Recession and slow recovery that followed. I then document the high costs of fiscal austerity, including over 1 million jobs lost and the downshifting of GDP levels and growth through scarring effects. Thank you.
Thank you, Dr. Bernstein. Dr. Selgin, you're now recognized.
Chairman Barr, Ranking Member Moore, and committee members, in October 2008, the Federal Reserve began paying interest on banks' reserve balances with it. My testimony today concerns the economic consequences of that step. The Fed was originally supposed to start paying interest on reserves in 2011 to reduce the implicit tax burdens reserve requirements placed on them. But as the 2008 crisis worsened, the Fed received Congress's permission to start paying interest on reserves immediately. Its goal then was not to relieve banks of a required reserve burden, but to get them to hoard reserves it was creating by its emergency lending, so that that lending wouldn't result in increased bank lending and inflation. To make interest on reserves serve this role, the Fed set the rate of interest on reserves above comparable market rates, where it has kept it ever since. The Fed thereby ignored the law's stipulation that the rate was, quote, not to exceed the general level of short-term rates, unquote. As an anti-stimulus measure, note well, interest on reserves worked as expected. In fact, it worked so well that within weeks the Fed did an about-face. Now it hoped to stimulate the economy by purposefully creating large quantities of fresh bank reserves. All told, the 3 subsequent rounds of quantitative easing created another $2 trillion of additional bank reserves. Yet because reserves still paid an above-market rate of interest, banks just kept on accumulating them as they had done and as the Fed had wanted them to do before QE when it was worried about inflation. If insanity is doing the same thing over and over again but expecting different results, then I fear it must be said that some officials at the time were not quite in their right minds. Although the QE stimulus was disappointingly small, the Fed's actions had other big consequences. By acquiring trillions of dollars worth of Treasury and mortgage-backed securities and borrowing from banks to pay for them, the Fed dramatically increased its footprint in the U.S. credit system. Before interest on reserves and quantitative easing, bank reserves were less than 1% of bank deposits. Bank loans, in contrast, were almost 100% of bank deposits. Today, bank reserves are 20% of deposits, and loans are just 80% of deposits. Before interest on reserves and QE, the Fed's assets were 7% of commercial bank assets. Today, that figure is 27%. Commercial banks are expected to invest the public's deposits productively, subject to regulatory guidelines. Central banks are not. Central banks are tasked instead with regulating the scale of commercial bank lending and deposit creation. According to the Fed's own guidelines as set forth in a pre-crisis publication, it is supposed to, quote, structure its portfolio and activities so as to minimize their effect on credit allocation within the private sector, unquote. The reason, the same guidelines state for this, is, quote, that hard-earned experience shows that, in general, market-directed resource allocation fosters long-run economic growth. In fact, there's a vast economics literature on what's known as financial repression. The term refers to the harmful consequences of policies, mainly in less developed countries, that divert savings from commercial banks to central banks and thus from more to less productive uses. That literature blames such policies for much of the world's poverty. The Fed's current operating system, with its above-market interest rate on reserves and bloated balance sheet, is very financially repressive. That is one reason for the continuing post-crisis productivity slowdown. Yet the same system, far from at least improving basic monetary control, has prevented the Fed for 5 years running from meeting the 2% inflation target it set in 2012. Distinguished committee members, Chairman Barr, a central bank that cannot control inflation, and especially one that cannot make inflation go up, is a central bank that is unable to perform its fundamental duties. To close, the Fed's new operating system, based on above-market interest on reserves, has had disastrous consequences. Yet despite these results, the Fed's current normalization plan would keep much of the current arrangement in place. I hope for the general public's sake that Congress will not let that happen.
Thank you, Dr. Selgin, and the chair now recognizes himself for 5 minutes, and I'll stay with you, Dr. Selgin. I appreciate your testimony, particularly about interest on excess reserves and the associated risks with that as a primary monetary policy tool. What are, Dr. Selgin, what are the risks and downsides and the distortionary impacts of replacing conventional open market operations with interest on excess reserves as the primary monetary policy tool for setting the Fed funds rate?
The original means before the crisis by which the Fed managed the Fed funds rate was through open market operations, where it would adjust the quantity of reserves available to banks to change the rate at which they would lend to each other overnight, which is what we're referring to when we speak of the federal funds rate. So that system worked while reserves were scarce, and so long as it was worth more to banks to lend funds than to hold on to them as excess reserves. And it worked very well. It was the system that brought us the so-called Great Moderation of the 20 years, roughly beginning in 1985. The new system, because banks under it aren't tempted to use their reserves, but instead hold on to whatever comes their way, in that system, monetary tightening or monetary control consists of the Fed's adjustment of these administered interest rates, the interest rate on excess reserves, and lower down the overnight reverse repo rate. The problem with that system is, first of all, as I mentioned, the Fed has not succeeded using it in gaining the control of inflation we normally would want central banks to be able to exercise. It simply has not been able to meet the 2% target that it specified, and that's partly because it's hard to do that when you can't get banks to lend more by creating more reserves. Under this arrangement, you have to rely on a so-called portfolio balance effect and other effects that work through tightening banks' demand for reserves or loosening that demand rather than by increasing reserves or changing the supply and having banks lend them more. But the other problem is that this new system requires that there be a substantial amount of excess reserves in the system. And that means that the Fed is, as I said, having a much larger role in credit allocation. And that means less productive use of credit. Central banks are not designed to invest funds productively. They cannot make any loans to businesses, farmers, or consumers. So their portfolio is necessarily limited, and that means that the use of funds when they're commandeered by the Fed is not going to be as helpful for economic growth.
Thank you. And Dr. Levy, in Dr. Bernstein's testimony, he made the argument that Fed reform that has been proposed by this committee would involve overregulation in this case of the Fed. When I think of overregulation, I think of Washington overregulating actors in the private economy. I don't think of Washington trying to keep entities that are part of the federal government accountable. And so regulating and holding accountable the Federal Reserve to a strategy-based policy that's transparent and accountable, I don't view that, as Dr. Bernstein does, as overregulation. Can you comment on that? And also, can you talk about the Fed's extension into credit policy as potentially contributing to the risk of fiscal inflation, and what the unconventional policies of the Fed may mean for the political independence of monetary policy?
Yes, on regulation, it is the role of your committee to supervise the Federal Reserve. And I think the general thrust of the Financial Choice Act provides you more ability to properly supervise the Fed. In response to issues about the Fed has to respond within 48 hours, the Fed has hundreds upon hundreds of very capable staff members that have already delved into all these issues. They've already written up before the meetings their approaches to the issue. So I don't think it's asking too much of the Fed to respond to questions. With regard to a rules-based, you want to make the rules-based flexible and allow flexibility to the Fed to deviate from those rules under abnormal circumstances, such as during the financial crisis, but then use that as a framework for explaining to the committee why it deviated. So you want a rule, but you want it to be flexible. And I think some of that is
My time has expired. I appreciate your responses to those questions. And the chair now recognizes the distinguished ranking member, Congresswoman Gwen Moore, for 5 minutes.
And thank you so much. This is just the most amazing opportunity of my lifetime to be able to sit and listen to people with the level of expertise that all of you have brought here today. And I have more questions than I have time. But let me start out with you, Dr. Bernstein, since I think you're sort of outnumbered here on the panel of experts. You said in your testimony that there was a high cost of fiscal austerity. Mm-hmm. And I'd like you to flesh that out a little bit for us. You said that at the end of your testimony.
Right. My testimony documents the impact on GDP growth, on jobs, on unemployment, from a premature pivot to fiscal austerity endorsed by Congress starting around 2010. Particularly in 2012, 2013, to be very specific, Congress's failure to renew the payroll tax holiday took something like $120 billion out of the economy at a time when the recovery was still slow to take off. And this led to the loss of about 1.5% of GDP, maybe around 1 million jobs that would otherwise have occurred had Congress not made this pivot. It's widely understood by economists that this type of premature pivot to fiscal austerity has been particularly damaging in Europe, where unemployment rates are still highly elevated. We didn't bite off as much of it as they did, but I present concrete examples of the damage this did to the economic lives of working families earlier in this expansion.
Well, I can tell you that the rest of the panelists have argued particularly, I think, Dr. Levy, and I'm going to get to him in a minute, about the importance of changing, the entitlement programs, lest we become too reliant upon them in favor of doing other things. And I guess I'm curious as to what those things will be. But right now, latest CBO report says that 32 million people are going to be kicked off Medicaid. There are, proposals to structurally change Medicaid. We have seen our speaker in the past talk about voucherizing Medicare, changing Social Security. What do you think the impact will be? Do you think this will solve our debt problem? I guess that's the narrative.
Are you asking me?
Yeah.
So I think if the House, particularly Republicans, were interested in chipping away at the debt problem that Mickey emphasized in his testimony, they wouldn't be considering trillions of dollars of tax cuts that are unpaid for.
Amen. And unpaid for wars. I appreciate that. In terms of, I'm interested in the fiscal policy, the rules-based fiscal policy. What prevents smart people from gaming the system, Wall Street wizards, when we have a rules-based Fed? First, Dr. Bernstein, and then maybe Mr. Selgin. Quickly.
Okay, quickly, I think that Mickey was just saying that you want a rule, to the extent you want a rules-based Fed, you want it to have flexibility. I would argue very strenuously that that is the antithesis of Title X in the Choice Act. There is a really strong attempt to undermine the Fed's discretion, and I think any objective reading of the rule would leave you with that impression.
Dr. Selgin, why couldn't a wizard on Wall Street game the system with a rules-based approach? Go on, go for it.
Actually, it's the absence of rules that's easily gained. It allows monetary policy to become a football that special interests try to influence, or Congress itself, for financing the deficit and any other number of reasons. And there's a long history of this kind of influence. A rule can be very flexible.
Well, it's an oxymoron to say you can have a rule and then it's going to be flexible.
Yes, let me explain.
They taught me that in algebra.
Yes. Rules can be designed so that they allow for reactions to all kinds of circumstances. And
Dr. Levy needs my last 20 seconds.
All right.
How would you change the structure of the entitlements?
I would look carefully at the structure of Social Security, look carefully at the replacement rates in it
Who'd
that
be
haven't
the
been looked at
losers?
since the early 1980s, to be fair and to protect older working people and phase things in a logical way. On Medicare and Medicaid, this gets into very difficult, including ethical
You brought it up.
issues.
I didn't. My time has expired.
Thank you. The gentlelady's time has expired. The chair now recognizes the vice chair of the subcommittee, Mr. Williams from Texas.
Thank you, Chairman Barr, and thank all of you for being here today. Dr. Selgin, I wanted to talk a little bit about the Fed's plan to begin unwinding its balance sheet. I think in your testimony you called it a recipe for failure. Why is that, and how should the Fed proceed so that its normalization plan has a meaningful impact on the balance sheet?
Thank you. As I mentioned in my testimony, the Fed has for some years now failed to reach its inflation target. I believe its plan for normalization will only make it more likely to fail again and more by a larger margin in the future. The reason is that the plan that Fed has announced involves two things: shrinking the balance sheet, which is itself a tightening measure, of course, and raising the interest rate on excess reserves that I've been complaining about in the next several years to over 3 percentage points, which is, of course, more than twice its current level. That's tightening as well. So you have a lot of tightening going on by a Fed that's already too tight according to its own inflation target. The Fed has also said, though, that if things get bad under its current normalization plan, it will consider abandoning the shrinking of the balance sheet it has announced, and may even turn to expanding it again. This seems to me, all told, a recipe for failure, and I'm sorry to have to say that I believe that the Fed is perhaps not all that keen on actually succeeding in becoming small again.
Okay, thank you. I want to quote, staying with you, I want to quote Mr. Bernanke. Of course, we've all heard him say, banks are not going to lend out the reserves at a rate lower than they can earn at the Fed. Well, I'm a borrower. I borrow all the time, and I can certainly appreciate a good rate, but the Fed's policy of giving above-market rates to banks that hold excess reserves, as we've already talked about, is troubling. A couple weeks ago, this subcommittee had a hearing called the Federal Reserve's Impact on Main Street, Retirees, and Savings. So in your opinion, how has this policy affected Main Street America, which I am and most of us are, and small businesses who want to gain access to capital, which is important in expansion?
Banks ultimately pick their portfolios, reserves, loans, whatever other assets they can acquire, so that the tendency is for them all to be worth the same amount at the margin, as we economists like to say. When you make it more worthwhile for banks to hold reserves by raising the rate on reserves, and particularly when you raise that rate above comparable market rates, the first thing that happens is banks don't make any short-term loans. They pull out of the wholesale markets. But in the long run, these adjustments include adjustments to other kinds of lending. And in fact, that's why lending is now, as I said, about 80% of total bank deposits, whereas for years before the crisis, total lending and total deposits moved together. So that difference between 100% and 80%, there's your small town lending loss.
Well, along those same lines, you also talked in your testimony about removing inefficiencies.
Yes.
And improving the environment for economic expansion. As it relates to our current debate on reforming the tax code, do you have any specific tax policy reforms Congress should focus on?
No, sir. I am not an expert on tax policy. I would be offering my private citizen guesses on that subject. I'd rather not.
Less tax would be good, though. You'd agree with that, wouldn't you?
Well, if it were less for me, yes.
All right. Mr. Levy, or Dr. Levy, in your testimony, you state that sound monetary policy ultimately relies on sound fiscal policy. Many of us in this room continue to be concerned about the long-term implications that our national debt will have on future generations. So you talk about monetary policy and government finances being interconnected. Can you go into greater detail on why policymakers, i.e. Congress, should not continue to ignore our national debt, and what are the long-term consequences it could have on monetary policy?
It's not just the deficit spending that increases the debt, it's what you're deficit spending for. When you look at how the budget has evolved, a large and rising share of it is being allocated toward income support. A lot of that's good, but a shrinking portion is being allocated toward policies like infrastructure, job retraining, research and development that would add to long-run productive capacity. Therefore, the increase in the debt and the allocation of the national resources generated by the structure of the spending programs is basically borrowing from the future and from future generations. And so the problem you face is, under current law, the policies, the tax policies, the structure of the spending policies will reinforce disappointing economic growth and only add to debt.
Gentleman's time has expired. The chair now recognizes the gentleman from Michigan, Mr. Kildee.
Thank you, Mr. Chairman, and to the panel, thank you so much for your testimony. Mr. Levy, I'd just like to pick up where Ms. Moore left off. She asked about specific structural changes in Medicaid, Medicare, Social Security. And I wonder, without going too deep, because I don't have a lot of time, if you could just give examples of what you mean by that, more specific examples of what you might mean by changes, and if you could just quickly identify changes in each of those three important programs.
Social Security, you have to look at the internal structure of the benefits, what's called the replacement rate, which hasn't been changed forever. You have to look at rates of return. People who are older and retired much earlier are getting extremely high rates of return on their Social Security contributions. You should treat Social Security income as an insurance policy and tax the extent to which it exceeds your inputs. By the way, I testified many decades ago and encouraged the Fed to encouraged Congress to tax a certain portion of Social Security benefits, and that's happening. So you really need to look at the underlying structure. Medicare and Medicaid are much more difficult. You start out with asking the question, why is the U.S. allocating about 18% of its GDP toward medical care without getting the results? And you have to look at the structure of these programs, including, as I was starting to mention to Congresswoman Moore, you need to get into this ethical issue. Are we appropriately allocating resources when so much of Medicare goes to the last 18 months of life, and in some cases, with very good examples, prolongs lives in ways that aren't positive. So these are ethical issues, I understand, but if you really address the structure of the programs without just talking about big numbers, and we're a wealthy nation. If we restructured these programs, there would be more than enough resources to ensure the indigent, the poor, et cetera, et cetera.
I appreciate that. The difficulty that I'm having, and you referenced it, and I would ask Mr. Bernstein to comment specifically on this. The frustration that I have is that, you know, for a lot of folks, and this I assume applies to both sides of the aisle, dealing with this question is sort of like in Washington, like the weather. Everybody complains about it, and nobody ever does anything about it. The issue that I'm concerned about is where we seem to see a willingness, at least with this Congress, to push down on public investment. It's in those areas where you would expect the greatest return, in the development of skills, in the kind of income support that's absolutely necessary to keep a family from completely tipping over and going to a tragic death spiral. Mr. Bernstein, I wonder if you might comment on how you think the current budget proposals might impact both larger economic performance, but specific issues that relate to families and communities.
Well, I would underscore the points that you were beginning to get at there, Congressman. If you look at the part of the budget that's non-defense discretionary, that's actually where a lot of the functions that you're describing live. And I actually agree with Mickey Levy's point. So take education, for example. Take access to college. The budgets that Republicans and President Trump have been sending up take those levels of funding as a share of GDP down to historical lows that we've never seen anything like before, lower than any point on record going back to the 60s when the modern data series begin. Whether we're talking about infrastructure, education, childcare, helping people get back to work, investing in communities, that's where that lives. And just briefly on the social insurance programs, on Medicaid, Medicare, remember, Social Security reduces elderly poverty from 40% to 9%. About 2/3 of Social Security recipients depend on that income for half, or at least half of their income. So this is the average benefit is $16,400 a year. Okay, we're not talking about lavishing money on retired people. So instead of chopping away at these programs, we should look at them as investments in our future. And I'm afraid that the current budgets that we've seen go exactly in the opposite direction.
All right, I think it seems as my time has expired. I yield back. Thank you very much.
The chair recognizes the chairman of the Capital Markets Subcommittee, Mr. Heisinger from Michigan.
Thank you, Mr. Chairman. And real quickly, this isn't the main part of what I want to talk about, but Dr. Bernstein brought up Title X and his concerns. I think they're unfounded, being intimately involved with the creation of the FORM Act, which then was put into the put into the Choice Act. Page 503, line 1, subtitle C, requirements for a directive policy rule. A directive policy rule shall, and it goes through 7, 8, 9 various things. Of that, it says the Fed needs to just describe what it's doing. Down at number 6, it says that they need to include a statement as to whether the directive policy rule substantially conforms to the policy rule that they wrote, and if applicable, A, an explanation of the extent in which it departs from the reference rule that, again, it wrote, not us, B, a detailed justification for the departure from the rule that it wrote, C, a description of the circumstances under which the directive policy may be amended in the future that they wrote, and then 7, include a certification of the directive policy rule is expected to support the economy in achieving stable prices and maximizing natural employment for long term. For a body that created the Fed, I think it's completely applicable that they explain it. I've got to move on though to Dr. Levy.
But can we argue about that?
No, because I've got 3 minutes and 30 seconds, but to get to another point.
Let's
we can take that up.
Let's take that up
at another time. Monetary policy. I believe Dr. Levy, you had said monetary policy has stimulated fiscal markets, but has not stimulated economic growth. And I agree. And you later then said something about large pockets of underperformance versus meaningful and fair fiscal reforms. That was in your opening statement, and we ran out of time. I wanted you to explain a little bit of that, how, because I've done some research into my own district here. My home county is at 2.6% unemployment. However, I have pockets, including in Muskegon County, which houses a place called Muskegon Heights, predominantly African American, about 10,000 people located within another city, where the official unemployment rate is in the low teens. That's not U6 numbers. That's the official unemployment rate. I have the poorest county in the state of Michigan, Lake County, again, heavily minority. I have the largest Hispanic district in the state of Michigan. And what we are seeing is those minority communities being left behind in unprecedented numbers compared to where the rest of the economy and society is accelerating. And I think it's exactly as you were headed towards. Wall Street is doing just fine. If you are a qualified investor, elite citizen, you're doing more than just fine. If you are Joe and Jane IRA, you're struggling because you're not able to get into it. And if you don't even have that investment account, you're really struggling. So I'd like you to expound on that, please.
Thank you. I give the Fed credit for the aggressive stimulus during the financial crisis and recession. That was 8 years ago. The effectiveness of its subsequent quantitative easing programs and low interest rates is highly questionable. Since QE3 in fall of 2012 and the implementation of forward guidance and sustained negative real policy rates, nominal GDP growth has decelerated. It has stimulated financial markets. It has not stimulated economic growth. I emphasize that monetary policy is incapable of addressing some of the pockets of economic performance and underperformance in labor markets in your district and nationally. Those need to be addressed with the proper policy tools. One of the critical points I emphasize is that if we identified the sources of the increase in debt and asked, how can we restructure those while maintaining the intent of the programs? If we did that properly, that would free up resources for us to spend on areas like you've mentioned, and in programs that would increase productive capacity. And I think that's critically important. Congress and the Fed need to understand the proper roles of monetary and fiscal policies, identify the sources of our underperformance and frustrations about the economy, and address them with the proper policy tools.
The gentleman's time has expired. The chair recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses. I'd like to quickly touch on one thing which was the subject of a recent Wall Street Journal op-ed talking about repealing the debt limit. A pair of very respected Democrats and Republicans made the case, and a number of interesting, well, besides just going over the history, they made the interesting point that at present the debt limit negotiations are being used by Democrats to increase spending, which is sort of contrary to the to the intent certainly of Republicans who have typically talked about and attempted to use it as a cap on spending. And so I would first like to just ask anyone who'd like to opine whether this is a useful mechanism. It's often compared to refusing to pay your credit card after you've made the purchase, and that we'd be much better off taking seriously the budget process and controlling spending, at the level of a budget resolution and so on. I wonder if any of you, Dr. Luper?
Yeah, I think that the debt limit is anachronistic and is almost counterproductive for what you want to do. It ends up increasing uncertainty about fiscal policy. As you say, it gets used as a political tool in a variety of ways. I think you would be much better off if you were to adopt some clear fiscal objectives. This is happening broadly in Europe now, where they may pick a debt-GDP ratio that they try to aim for. They may build in limits on spending that are bound by revenues, and so forth. And I think what all of that
sort of
does...
the point of a budget resolution, that's, the way it should, properly enforced and take...
Let me just add one thing, but I think one of the key points is that in a lot of these European economies, there is an outside entity that evaluates policy. And the CBO, for all of the good that it does do, can't play that role. And so there are these fiscal councils that I think actually have been very constructive in Europe.
I think Eric's point about the anachronism is exactly on target. I think your point, and there's a great deal of confusion about this, that failing to raise the debt limit is failing to pay for spending that this body has already approved. And so it is much like saying, I've decided not to pay for the meal I just ate. But third, it was interesting, I think it was Mr. Davidson, I don't know if he's still here, earlier talked about the damaging to the economy of uncertainty in our policy environment. Fooling around with the debt ceiling, which has become kind of unfortunately, a Washington tradition, absolutely boosts that kind of uncertainty in a way that I would think this committee would consider to be anathema. I would also say the same thing, by the way, about health care. I can think of almost no way to further increase uncertainty in health insurance markets than by continually failing to nail down what it is this country wants to do with health care reform.
Yes, Dr. Levy?
I think it would be much more constructive if Congress really reassessed its budget processes. What I've seen over the last couple decades is what started out as identifying entitlement programs as entitlements versus discretionary programs that have to be appropriated through the appropriation committees every year. This has evolved into entitlement programs are mandatory. And then you have discretionary and then non-defense discretionary. So as Dr. Bernstein noted, the current budget proposal for fiscal 2018 really it proposes significant cuts to non-defense discretionary programs. And the reason why it does that is because the entitlement programs, which are mandatory, are just psychologically thought of to be off the table. And so I recommend really rethinking the budget process rather than hanging your hat on the debt ceiling.
And one of the key elements that's missing in the U.S. budget process is something present in many parliamentary systems, is that if you fail to pass a budget by a date certain, that calls a new election. And if we had a mechanism like that, I think the dynamic would change.
Gentleman's time has expired. The chair recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Thank each of you for being here today and for your expertise. Dr. Selgin, we are 8 years out of the recession. In great measure, the American households and businesses have certainly not been able to climb back to their full economic potential. We have the largest demographic group in the country, low-income minority people today. Is the Federal Reserve's accommodation of unsustainable fiscal policies and favoring some sectors over others in credit markets holding our economy back?
Yes, Congressman. As I said, to the extent that the Fed is shunting savings into the mortgage market, the market for mortgage-based securities, and into the Treasury, which savings might be instead employed for productive bank lending, but also where that includes not just lending to businesses, but to farmers and consumers, because consumer lending is also productive, or can be. To that extent, the Fed is constituting its policies are a drag on economic growth. We've always depended heavily on bank lending as one of the important contributors to economic growth. And even though it must be said that banks sometimes do very bad things when they're lending, and we saw plenty of that in the last crisis, nevertheless, without robust bank lending policies, we will have less economic growth, and that harms everybody.
Thank you, sir. Dr. Leeper, would you concur that unsustainable fiscal policies and favoritism of certain sectors work against what the Fed has fought so hard for throughout the history, and that is monetary policy that is independent of distributional politics?
Yes, I generally agree, and the best, was I supposed to?
I don't know.
Dr. Leeper, I asked him, but I'll have you to comment.
I apologize.
That's all right.
I guess that I have a somewhat different view about this. Whether we want to call what the Fed did fiscal policy or not seems fairly arbitrary. I mean, the point of my testimony was that monetary policy always has fiscal implications. And so, you know, do we want to say that, and what I mean by that is that it has implications for tax and spending policy. And so by that definition, we could say everything that the Fed does is fiscal policy. So I'm not sure that I see that as a useful label. But beyond that, I think that the biggest issue that is happening now is take what I was saying about when the Fed tries to reduce inflation by raising interest rates and turn it on its head. It's a symmetric argument. So when the Fed reduced the funds rate dramatically and kept it near zero for many years, the kind of fiscal backing that was necessary for that to have beneficial effects on the economy was to run higher deficits. And while there was the ARRA, that petered out, and it's not clear that the fiscal backing that the Fed needed for that interest rate policy to be effective was forthcoming, or that people expected it would be forthcoming.
Thank you. Dr. Levy, you're welcome to respond.
I agree with Dr. Leeper, and I would, let me just add this point about the Fed's holdings of mortgage-backed securities is clearly step over the boundaries into credit allocation, and maybe we could legitimize the purchases during the height of the financial crisis. A week after the Fed started QE1, Chairman Bernanke stated this is an extraordinarily emergency measure and we're going to unwind it on a timely basis. Well, they haven't unwound it. It's even gotten bigger. The Fed shouldn't be involved in credit allocation issues. And I think their strategy to unwind its portfolio should be go much further to go back to an all treasuries portfolio.
Thank you. My time has expired. I yield back.
The gentleman from Texas, Mr. Green, is recognized.
Thank you, Mr. Chairman. Thank the witnesses as well. Mr. Chairman, I've been here long enough to remember when the contention was that QE was going to create runaway inflation. The contention now seems to be that QE has been the reason for our not having the inflation that we have targeted. I can also remember when we had this theory presented to us of expansionary fiscal contraction, and that expansionary fiscal contraction was going to be the means by which we would save the world. Well, let's just examine some of this, and I'd like to talk to Mr. Bernstein, if I may. Mr. Bernstein, expansionary fiscal contraction contemplates layoffs, contemplates cuts, and to a certain extent does not allow for the infrastructure projects needed at a time when the country could afford them, when interest rates were low, didn't allow for that. And my friends who were pushing expansionary fiscal contraction don't seem to think that that has an impact on economic policies that are perpetrated, if you will, by the Fed. These things work hand in hand. So, Mr. Bernstein, if you would, talk for just a moment about how the impact of expansionary fiscal contraction, to the extent that my colleagues have engaged in it, and they've done everything that they can, it seems to me, to cut and gut. The infrastructure programs haven't come online. Would you talk for just a moment about it, please?
So what you're calling expansionary fiscal contraction, I called austerity measures. And in fact, aptly described, these would be contractionary fiscal measures. Simply by definition, an increase in government spending increases GDP. That's arithmetic. However, there are many moving parts, and the Federal Reserve, if they believe the economy is too close to full employment, will offset fiscal stimulus at times like that. The quote that I presented in my written and spoken testimony was Ben Bernanke coming to this body a few years ago when the expansion was proceeding at too slow a pace, saying not only will the Federal Reserve not increase interest rates to offset fiscal stimulus, but it views it as complementary. We've seen in Europe the damage that fiscal austerity has done to growth when the pivot to deficit consolidation has occurred too soon, and we've seen it in this country as well. It's one of the reasons why it took so long for the output gap to close, and in fact it's barely closed now, 8 years into the expansion.
And if you would, explain to us some of the things that could have been done that would have complemented the QE of the Fed.
I think the most important types of fiscal complements would have been in the area of infrastructure investment, increased unemployment insurance compensation at a time when the job market wasn't where it is now, when the job market was still having trouble closing in on full employment. And I thought the payroll tax holiday, as I show in my testimony, I have a graphic of the impact of GDP, shaved about 1.5 points off GDP in 2013 by prematurely ending what we call the payroll tax holiday. I do want to make one quick other point, if I might, which is that there's been a considerable amount of criticism of some of the work that the Federal Reserve was doing in this period. Eric said earlier something to the, George said something early to the Fed had an increased footprint in the credit system. Well, in 2008, and I often think that we do have some economic amnesia around these points, the credit system was completely shut down.
If you would, let me just assist you with this. It was shut down to the extent that banks wouldn't lend to each other.
So
that's pretty significant.
The Federal Reserve it simply was manifesting its role of lender of last resort in the way that the Congress created it precisely to do so. Now, we can have arguments about how quickly they've unwound. I thought it was interesting to hear Mickey say that the housing market is booming and then be so critical of the MBS program. There's no question, either in my mind or in the research that I'd be happy to share with the committee, that those two phenomena are related.
Let me make one quick point. We've had CEO salaries to increase greatly. Last year, the number one person on the top 10 CEOs in terms of salaries had about $98 million as a salary, 499% increase. Question for you, increasing the minimum wage, the impact of that, please, on the economy.
Quick answer. The time has expired, so quick answer.
Okay, moderate increases in the minimum wage consistently have their intended effect of boosting the earnings of low-wage labor, diminishing the inequality you're talking about without substantial job loss effects.
Thank you, Mr. Chairman. I yield back.
Thank you. Time has expired. The chair recognizes the gentleman from Arkansas, Mr. Hill.
Thanks, Chairman Frank. Thanks for this continuing set of hearings on monetary policy, fiscal policy today. Appreciate such a distinguished panel joining us. Appreciate everyone's time and your excellent testimony. You know, we've talked about fiscal policy, monetary policy, the topic of the hearing, but I'd like to raise another constraining factor I think that was at work during this period, which I'd like maybe Dr. Levy for you to start out with, and that's the non-monetary policy structural impediments of our regulatory system and how I think that's constrained growth to some degree. We've talked a lot about across the economy, not just Dodd-Frank. This is not a Dodd-Frank comment, but labor market regulation, environmental regulation. These all were on the upswing during this contractionary period where we were trying to get the economy growing again. But certainly in the credit allocation aspect, Dodd-Frank did have impact on certain aspects of credit and not making it flow as well. Would you address sort of that administrative state, non-monetary policy, non-fiscal policy aspect of constraint on growth?
Yes. I believe that one of the factors that has led unprecedented monetary ease not to stimulate the economy has been some of the inhibiting factors on both aggregate demand and supply and production due to the growing web of regulations that you mentioned, not just on the federal level, but on the state and local levels in the non-financial sectors. The list goes on, it's expanding, and what it does is while the Fed has been very, very successful through its policies to lower the real cost of capital, businesses, when they think about investment projects and hiring, they think about all the regulatory environment, the current and expected tax environment, and their hurdle rate for taking on projects stays very high, and they put a wide band of uncertainty about it. So I think these are definitely having an impact on the non-financial sector. It's also clear that the implementation of portions of Dodd-Frank, particularly the stress test and some of the micromanagement, is clearly affecting banks' willingness to lend. So both in the financial and non-financial sector, I think this regulatory environment is very, very important.
I appreciate that.
It has slowed potential growth, and it has inhibited the Fed's policies from working.
Thanks. That's my view as well. I think it's a good area for research for our PhD community to really look at that, both in labor policy and financial allocation policy. Dr. Selgin, let's talk about the balance sheet. Governor Powell's laid out a long-term normalization process for the Fed. And to me, that's very important. And we were at about 6% or so of GDP in terms of Fed size. We're up around 24% of GDP. The chairwoman was here, Chair Yellen, and she talked about, well, we're not going to ever go back to kind of where we were. But if we look at 6 or 8% of GDP for total Fed balance sheet footings, that'd be, I don't know, $1 trillion to $1.4 trillion, up from, say, $900 billion before the crisis. Do you see any reason for the Fed balance sheet to be larger than where it was in the range before the crisis?
Yes, there is a reason, but it isn't a reason for it to be as large as they are planning to make it when they're done with normalizing. And the reason is the Fed is the sole supplier of currency. If we allow for the trend of currency growth, to that extent, the balance sheet today would have to be bigger than it was in 2008.
What about as a percentage, though? Do you see?
Oh, I'm sorry. As a percentage,
that's why I'm saying between $1 trillion and $1.4 trillion would be the same range.
I apologize. As a
$18
percentage
trillion.
of GDP, there is no reason. I'd like to address Dr. Bernstein's remark about the footprint. Let me be clear. The reason the wholesale markets shut down in October 2008 was because the Fed purposefully shut them down using interest on excess reserves and wanted to keep its loans from spilling into the wholesale market. You cannot celebrate the Fed for saving the wholesale market and the banking system when, in fact, it did the opposite. I quite agree that it should have been a hero, but it wasn't. It was the villain in this story. And even if it was justified in expanding its balance sheet back then, it certainly isn't justified 8 years afterwards, 9 years afterwards.
I guess I would just ask, what about the housing bubble?
What about the housing bubble?
Yield back, Mr. Chairman.
The time has expired. The chair recognizes the gentleman from Minnesota, Mr. Emmer.
Thank you to the chair, and thanks to this fantastic panel and this discussion. Dr. Levy, hopefully I said it right, Levy, you were talking, it just interested me this morning when you said, sustained monetary easing has failed to stimulate the economy. In fact, what it's done is it's stimulated financial markets, but hasn't stimulated economic growth. And then you commented about fiscal policy has created this huge debt. And your testimony is both need to be reset. You think the Fed should be more aggressive in the unwinding, was your other piece. Could you just comment on that?
Certainly.
Its balance sheet is what you were talking about.
For a variety of reasons, the Fed's maintaining a $4.5 trillion economy, over $2 trillion is basically sitting as excess reserves. The banks are not lending it out.
So I understand that, and I don't mean to interrupt, but I want to keep this on track, because what I'm going at is Chair Yellen has suggested kind of a 5-year, when you talk about aggressive, what do you think should be done? Is that the right timeline? Should it be shorter?
I actually think 4 or 5 years is just fine, because then most of it could be unwound in a passive way. They wouldn't have to sell it. It could just unwind through amortization. But I do take issue with the Fed on a critical point. It should be going back to an all treasuries portfolio. Yes, the Fed's subsidies of the mortgage market are helping housing, but that bids up prices of housing, and it's high-income people who own housing, and it also bids up rental prices and exerts duress on low-income people.
Yeah, Dr. Leeper, I was interested when I read your testimony before the hearing today. You go back to the 30s, and you talk about what, those of us that don't have your background, but we're just from Main Street, USA, and not from the coasts. We already think the Fed has hurt its credibility, and quite frankly, the government, because of a story that you tell with President Roosevelt, where he changed monetary policy purposely because he was going to inflate the currency and reduce his debt. But you, our debt, I guess, but you talk about this unwinding. We got a big problem as we raise interest rates. How do you do this and survive?
Well, I think that's a very good question. And my feeling about that is for you to understand that through that fiscal channel, in other words, if you raise interest, if the Fed starts to normalize interest rates and debt service rises and Congress doesn't respond by adjusting taxes or spending to accommodate that, those increases in interest rates are likely to end up in higher inflation rather than lower inflation.
Right.
And so understanding the nature of those interactions.
And you may
is
not
what
be
it's
able to
about.
control that.
Right.
I mean, this is the
well,
issue.
It's within your control because you control the budget.
Well, I understand that, but I mean, once this gets away from them, that's what they're desperately trying to maintain, is make sure that you want a certain amount of inflation, but you can't have it run away. And by the opposite side, if you do the wrong things, you could encounter deflation, which would be every bit as damaging. Dr. Selgin, why don't you talk about that a little bit, address how we get out of the place that we're in?
What we need to do is to get back...
And by the way, Dr. Selgin, the one thing I do want to ask you, because I get this mixed testimony, what has the Federal Reserve done in the last 3 decades that has worked? Let's reduce it. What have they done in the last decade that has worked, sir?
In the last decade?
Yes.
Oh, not much.
I mean,
Not
can you
much.
point to anything that, I mean...
Well, as I said, the problem is the Fed undermined its own operating mechanism with this interest on excess reserves policy. It put the monetary transmission mechanism, as we call it, in neutral. It steps on the gas, nothing happens.
Right.
Reserves pile up. The Fed is its own worst enemy as far as being able to affect total spending in the economy and control inflation because of policies it implemented in 2008. It has wrecked its own transmission. It did it at first because it was worried about inflation. Now, with the same setup in place, it can't get the inflation it wants. This is not surprising, really. Yes, quantitative easing had some effect, but much less than it would normally have had because the reserves were made to pile up in banks. I don't want to say that the Fed has never had some relatively sound policies, but I do say that their change in their monetary control mechanism, implemented since the crisis, has been a disaster. We need to go back to the old control mechanism or something not too dissimilar from it.
Time has expired.
Thank you.
And
Thank
that's
you,
the
Dr.
key.
Selgin.
Chairman Barr, can I make let's say one sentence?
Well, the time has expired, and
Okay.
Mr. Sherman may give you that opportunity, and I now recognize the
Thank you.
gentleman from California, Mr. Sherman.
I have my own questions. I'm looking up at that debt clock. Quantitative easing raised, Mr. Bernstein, maybe you have the number, I believe it was many tens of billions of dollars for our country last year. That is to say, the amount the Fed turned over to the Treasury. Do you happen to have the figure?
Off the top of my head, 500 billion cumulatively.
Oh, well, not in 1 year.
No, I'm talking about.
Dr. Levy, do you have a one-year number?
The Fed remitted in fiscal 2015 $117 billion. That number's come down to about 85, largely because of the amount it's raised rates, so it's paid excess reserves.
So we got a
to the
debt
banks.
clock up there, and we'd be hundreds of billions of dollars higher if the Fed had not remitted the money.
Yeah.
We're told that we have a disaster. We've got one of the longest periods of time with economic growth quarter after quarter. The number I have for 2016, by the way, is $92 billion, which is very close to what Dr. Levy had to say. We're told that we can't get the job-producing benefits of low interest rates for too long under too many different circumstances. Otherwise, we'll have inflation. Dr. Bernstein's inflation a big problem?
No, I mean, first of all, the remittances I was talking about were cumulative, so about $100 billion a year over the last 5 years or so is off the top of my head.
Yeah.
No, I mean, and let me just correct the record. I think you would be very hard-pressed to find an economist from any side of the aisle who would assert as strongly as George just did that the Fed played no role in helping to offset the damage of the Great Recession. We can have really good nuanced arguments, and we are having those arguments today about how effective it was and the roll-offs and things like that. But the Federal Reserve was, in my view, and I have evidence in my testimony,
Dr.
extremely
Bernstein,
effective.
let's go to the benefits of the Fed giving $100 billion to the United States Treasury. I'm told by those in the field that this is extraordinary, shouldn't be the real focus of things. It's just $100 billion. Do not pay attention to it because the Fed has other objectives. And I'm looking at a debt clock. And to me, $100 billion a year is not something I'm going to ignore just because the tradition in the field is to ignore it and say that's not the objective. Maybe the objective should be the $100 billion. What would we do to turn it into $200 billion?
Look,
please don't dismiss the goal.
These remittances have certainly been important. They are a residual.
Dr. Bernstein, I asked you a question. What would we do to...
We'd have to increase the level of the Fed's balance sheet, and in fact, they're going in the other direction, obviously.
And they know they're going the other direction because we had Janet Yellen in here tell us, oh, that isn't important. That isn't our mission. That's not what we focus on. I'm looking at the debt clock. I don't know what they focus on. I don't know what you can't focus on it because you'd have to turn around, but I'm focused on it, and it was put up there by the majority.
I'm well aware of what the debt clock is ticking away there. I look.
So why shouldn't we give a very high priority to hundreds of billions of dollars?
Because you have to ask yourself, is increasing the Fed's balance sheet the right monetary policy right now? Now, you can definitely...
Well, okay,
You can make the case.
There are tremendous benefits from that as a monetary policy
There
as well.
have been many more benefits than my colleagues on the panel have acknowledged, and in fact, I was just looking at a figure.
Without that policy, we wouldn't have as flat a debt curve.
Yeah.
We wouldn't have as much investment in the economy. Property values would decline.
But if
jobs would decline.
Yeah.
People would go hungry, and that debt clock would be going faster. Exactly what's bad with a bigger balance sheet again?
Well, first of all, let me just say that if this body really wanted to get that debt clock going the other direction, then we wouldn't be looking at budgets that continually pursue trillions of dollars of unpaid for tax cuts. To me, it's the fiscal policy.
This is the Financial Services Committee. If I wanted to get on Ways and Means, I should have cut a different deal. Again, what... Okay, so we could...
So if your
let me
point is
get
that-
this straight. If we enlarge the balance sheet, we can slow that debt clock by, instead of doing what the Fed's doing, which is taking away the 100, we could add another 100 billion in debt relief. I don't know whether Dr. Levy's going to be called on or not. But
the gentleman's time has expired, and in addition to the debt clock, we have another clock that we're focused on, and that is the clock, the remaining time to vote. We're going to clear these last two members' questions, and then we're going to have to adjourn. The gentleman from Ohio, Mr. Davidson, is recognized.
Thank you, Mr. Chairman, and thank you to our witnesses. I really appreciate your testimony. And I note that, as is normal in these hearings, we hear folks from the other side of the room talk about this period of austerity. It is occasionally that we have a witness on the panel also reference austerity. And I just want to ask, Dr. Leeper, does the trend that we've been on since 2010 represent a period of austerity fiscally?
I think that what we have done is very much what lots of other countries have done, which is, in response to the crisis, we did a fiscal stimulus, and then we immediately began to wring our hands and talk about how, don't worry about this fiscal expansion because we're going to contract. Within 6 days of passing the ARRA, President Obama was pledging that he was going to reduce deficits by half.
Right.
I think this is very confusing to people.
Yeah, so thanks. And I take a little bit of exception with the idea that somehow my reality of the small business guy not having confidence in Congress or the Fed to be somehow we need to provide certainty to the market. Certainty is something I'll talk about in a bit. Certainty of bad outcomes is not a good thing. Certainty of good outcomes is great. And when you look at the markets, in the year you talk about Obama, there was some doom and gloom. There was a lot of uncertainty. There's a lot of regulatory uncertainty. And with the change of administration, what you've seen is still some uncertainty, but a lot more confidence. 3-year high in business confidence. The markets are rallying because people believe there's going to be a change. I would say the simple answer is no, that does not represent austerity. It represents an awful lot of spending. If I could go to the next slide I'm on, I cycled it a bit ago to show this is the net result of all of the tax revenue we collect and all of the money that we spend. This year, we're on a path to spend roughly $700 billion more dollars than we collect. Unfortunately, at the start of the year, the plan was to continue on this path. As Herb Stein said, and I referenced earlier, if something can't continue, it will eventually stop. Dr. Selgin, when will this no longer be sustainable? When will it stop? This is the uncertainty we're all looking for.
I once again defer to the others. That is not my expertise. I've heard a million predictions about this, and I don't dare say which of any of them is correct.
Dr. Levy, you'd like to comment?
The answer is nobody knows when things become unsustainable. I want to hit on a critical point you made, Congressman Davison. This term austerity, I'll just ask in lay terms, how can you say the budget is austere when year after year you're spending more than you're taxing? And I might note, the European example was used earlier, the austerity in Europe hurt those economies because 80% of the budget deficit reductions were through tax increases that harmed economic activity. So I think we need to think seriously about, once again, what we're deficit spending for, and can we achieve the intent of those programs, but just restructure them so that they're more efficient. But the bottom line, the answer to your question is nobody knows.
But no one knows precisely when. We just know that it's not possible. So if you look at our debt to GDP ratio, as the slide that I started out on, that's not sustainable. At some point, we see what happened in Greece. I don't have their slide. Eventually, people lose confidence in our debt market. And in fact, part of the reason that the Fed's balance sheet grew is we didn't have a place for some of the debt to go. No one had confidence to buy the assets, in this case, mortgage-backed securities, and it would cripple the macroeconomy if we didn't do something. That was the fear. Oh, you could do something. Was it the right thing? It seems to have worked so far. I think it's unconventional, and we should have changed course. We are unwinding it, and as we're unwinding that, my time is unwound. So I'd love to talk to you more, but my time has expired. Mr. Chairman, I yield back.
Gentleman yields back. Chair recognizes the gentleman from Indiana, Mr. Hollingsworth.
Well, hearing my colleague talk, I'm often reminded of that old adage when somebody was asked how they went bankrupt, slowly at first and then suddenly. And so, like you said, no one knows when it might happen, but it might happen suddenly. And I'd like to welcome all the panelists here, but certainly Dr. Lepper, who comes from the most beautiful district in the country, I like to say, Indiana's 9th District, and appreciate you being here. Reading through your testimony, one of the things that I wanted to talk about was the combination of unwinding the balance sheet at the Federal Reserve and large fiscal deficits that are expecting to expand over the next couple of years, over during that 5-year period, and just the amount of capital that is going to soak up and what that implies for crowding out investment in the private sector and other issues, and kind of just your general views on the combination of those two.
Wow. I actually would like to think about these separately, to tell you the truth. No doubt there will be some interactions, but I don't think that it's something that we understand terribly well. My points about the interactions between monetary and fiscal policy are really independent of the size of the Fed's balance sheet. The magnitude of the Fed's balance sheet per se doesn't affect, for example, how much
I guess it's hard for me
interest
to imagine.
payments.
Right,
Yeah.
so as they shrink the balance sheet, right, private capital is going to have to come in to fund the rolling over of those treasuries. And then in addition to that, new treasury issuance on account of current deficits, the combination of those two gets to be a pretty sizable amount of capital that's going to fund deficits and fund previous deficits that used to be held at the Federal Reserve.
Yeah, but there doesn't seem to be any shortage of demand for treasuries.
Today.
Well,
Yeah, which kind of gets to
yeah,
my question.
today, but a lot of that demand is coming from overseas. So I don't think there's any reason to think that there's going to be a huge crowding out that occurs during the unwinding.
Okay. One of the other things that we've talked about several times in committee, and you've heard it here today, is interest on excess reserves. Now, Yellen's made the frequent argument that she is, or the Fed itself is incapable of controlling the Fed funds rate without paying these interest on excess reserves. Is that something that you believe or buy into?
As a matter of public policy, I've yet to hear a persuasive argument for paying above market rates on excess reserves.
Great. Fantastic. And then one of the other things I wanted to talk to you about, and I certainly know the dual mandate that the Fed has right now, but just clean slate, what's your view on maybe an increasing academic literature around targeting nominal GDP or nominal GDP growth versus a dual mandate of price stability and full employment?
That's a good question, and I think it cuts.
Finally found one.
I think it cuts on the issue of whether the Fed ought to be held accountable to a Taylor rule or something like that. Right. What the academic literature tells us is that something like an inflation targeting rule or a nominal GDP rule is actually far superior to a Taylor rule. And the reason for that is that Taylor rules can instruct the Fed to do strange things depending on what shocks hit the economy.
Right.
So, for example, if you get an oil spike to oil prices,
transient price shock,
it raises prices and it lowers output, and the Taylor rule is going to tell the Fed to contract.
Right.
And so, whereas if you have an inflation targeting rule,
right,
you would be able to avoid that kind of instruction.
And for clarity, in the previous legislation that we've passed out of this committee, there is, though the Taylor rule is frequently talked about, there's no specific rule that's demanded, but just a more rules-based monetary policy regime. Second piece that I wanted to ask about, and my colleagues might be annoyed at the number of times I ask about this, but something I'm growingly concerned about is the relationship between full employment and wage growth, and how anemic wage growth has been despite, I guess, approaching full employment. And something that I worry about is that, in fact, the Phillips curve turns out to be nonlinear, or might be nonlinear, and we might be approaching a time period where the Fed will be far behind the curve because they've pushed full unemployment and pushed unemployment lower and lower, only to find ourselves now behind the curve as the Phillips curve, as the part of the Phillips curve that's nonlinear begins to take over. Is there something to worry about there? Or is that something that some of the academic literature has talked about and been concerned about?
I think there's nothing to worry about there.
Okay.
I don't think there has ever been a time when there was a stable relationship between unemployment and inflation. And there certainly are likely to be nonlinearities.
Yeah.
But the idea that suddenly inflation is going to shoot off, I think is really nothing to be concerned about.
Wonderful. Well, thank you so much for being here and traveling all the way from Indiana. I yield back, Mr.
The gentleman yields back, and I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for the response. And I would ask the witnesses to please respond as promptly as you are able. Thank you all for your excellent testimony today. This hearing is now adjourned.